There's obvious reasons for what's going on here, and you've talked about them, higher interest rates. But you've got to think about what the positives of higher interest rates imply. They imply that the economy is growing faster than was expected just a couple of months ago. That's at least in part due to the tax cut. It's at least in part because of the presumption that there will be infrastructure spending. And what that means is that profits are going to be higher than expected. So yes, higher interest rates are a negative on stock valuations, but higher profits are a positive on stock valuations. And then in the end, that's what's going to win out in this debate.
You know, so Peter, we just mentioned, or Dom did in that piece, that we're on track for what may be the worst week for stocks since 2008. This is not 2008, is it?
No. And, you know, for those that are just tuning in, you know, I think it's important to realize there's a couple of hypotheses about what is going on. And let me just share my 2 cents. I think that there is one or two things happening here. Regardless of interest rates, et cetera, I think that either investors and analysts, especially analysts, are looking at stocks and they're trying to reassess the values of stocks given the fear of interest rate hikes, all right? So you say you got 30 analysts following P&G. Well, 30 analysts changing their opinions doesn't necessarily translate to that kind of volatility that we've had today, because analysts are pretty staid in their opinions. So I don't expect them to change their opinions that much. So maybe that isn't what's happening. Maybe what else is happening, though, is that you've got this computerized trading, and when the sell triggers kick in, occasionally all these computers are in sync, and maybe that's what's causing this additional volatility. Not that analysts are changing their opinions so quickly, but something is changing opinions quickly. I don't think it's human. I think it could be a mechanical implement that's put in place that is in sync occasionally, and I would prepare ourselves for more of these kinds of swings, given that those are the names of the game right now, where we have more computers, not less. And so back in 2008, it was a very different story.
Right. 2008, we were very worried about a financial crisis. But, Jim, we've got you here to bring some names that people maybe are interested in. You were going to suggest Citigroup. I mean, if we were in 2008, you would never be suggesting that, right? So that emphasizes this is not, we're not in the middle of a financial crisis here.
And why don't we talk about 2008 just for a second? In 2008, Citigroup had $200 billion plus of liabilities that had to be backstopped by the government. These inverse volatility ETFs that we're talking about, you know, they total something like $8 billion. We're just not talking about the same size here. But in Citigroup, the reason that I'm recommending it is because it's a direct beneficiary, as is the rest of the banking sector, of higher interest rates. They lend at a lower interest rate on the short end of the curve, and they lend at the higher interest rate at the longer end of the curve. They borrow at the shorter end of the curve. They want that difference, that steepness in the yield curve that has developed. That's positive for Citigroup.
What they pay you on deposits is much smaller than what they charge you for a loan.
As you have noticed, correct?
This
Any
is how
consumer
banks make
has
money.
noticed.
Right,
Exactly. It's called the net interest margin. And by the way, I'm not a genius for saying this. This is just common sense. So in a moment like this where the markets are going haywire, just use your common sense. Higher interest rates are better for Citigroup.
Peter, you like two companies, you can mention all three, but you like two companies that feel to me like very classic, stable consumer plays, Procter & Gamble and Verizon. Nobody's given up their cell phone. Nobody's stopped doing the laundry now, are they?
That's absolutely right. And, you know, the additional boost to P&G these days, of course, it's down 12% year to date. But we also have this additional stimulant of Nelson Peltz, who is officially going to be on the board in a couple of months. And so that activist can maybe give a little bit of a nudge to a very well-run company, but a company that could probably be even better well-run. And so here's an opportunity. It's paying almost a 3.5% dividend. It's down about 12%. It's a classic company, and I think it's been thrown out with the bathwater, as we have commented on many times today.
Sure.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.